Jenna, I think this module has one of the highest looks easy, destroys people on the exam ratios and FAR. It's not because the rules are complicated. It's because every question starts with, the company changed something. Quote, and suddenly you're trying to remember whether to fix the past, ignore the past, or pretend the past never happened.
Exactly. This entire module becomes manageable if you stop memorizing individual rules and instead ask one question first. What changed? Not how big it is. Not what account is involved. Just identify what changed. Once you classify the change correctly, the accounting treatment almost always follows automatically.
So, this isn't really an accounting module. It's a classification module.
That's a great way to think about it. There are really 4 buckets from your Becker materials. Changes in accounting estimate, changes in accounting principle, changes in reporting entity, and error corrections. Everything in this module fits into one of those 4 categories.
I already know where people get into trouble. They hear change, panic, and think everything gets restated.
Which is exactly wrong about half the time. Let's build a decision tree you'll use throughout the episode. If management simply learned new information and updates a prediction, that's usually an accounting estimate. If management chooses a different acceptable accounting method, that's usually an accounting principle. If they're changing who they're reporting as the company, that is a reporting entity. And if they discover something was simply wrong, that's an error. Once you've answered that question, the rest becomes much easier.
Let's start with estimates because Becker puts those first. When I hear estimate, I think forecast. Nobody actually knew the correct answer before.
Perfect. An accounting estimate changes because new information becomes available. Nothing was necessarily wrong before. The company simply has better information now. Becker gives several examples. Changes in useful lives of fixed assets. Adjustments to bad debt estimates. Inventory write-downs. Warranty estimates. IRS settlement estimates. Revisions involving discontinued operations. All of those involve judgment.
Here's my analogy. Suppose the weather forecast yesterday predicted rain on Friday. Today, new satellite data comes in and now the forecast predicts sunshine. Yesterday's forecast wasn't an accounting error. It was simply the best estimate available at that time.
That's exactly the right mental model. Accounting estimates work the same way. The company isn't fixing a mistake. It's updating expectations using new information. And because yesterday wasn't wrong, we don't rewrite yesterday.
There's the first big rule. Prospective.
Right. Becker emphasizes prospective application. That means today's change affects today and future periods. Prior financial statements stay exactly as they were. No retained earnings adjustment. No restatement. No pretending management owned a time machine.
The depreciation example really makes this click. A truck originally expected to last 10 years now appears it'll last only 5. The first few years weren't incorrect. The company simply learned something new. So depreciation going forward changes. Yesterday stays yesterday.
Exactly. The Becker example walks through recalculating future depreciation based on the remaining carrying amount and the revised remaining life. Notice what's missing. No journal entry correcting prior years. No revised financial statements. Everything moves forward from today.
Now, here's the exam trap everyone talks about. Depreciation method changes. Straight line to declining balance. That sounds like a change in accounting principle. Different method. Different principle. Done.
It sounds that way. But Becker specifically identifies this as an exception. A change in depreciation method is treated as a change in estimate because it's inseparable from a change in estimate. That's one of the highest value facts in this module.
This always felt strange to me.
It is a little counterintuitive. Think about why someone changes depreciation methods. Usually because their expectations about how the asset will generate benefits have changed. So, although a different method is being used, the underlying reason is an updated estimate about future economic usefulness. Nonsense. Therefore, prospective treatment, not retrospective.
I guarantee that one shows up on exams.
It absolutely deserves extra attention. Whenever you see depreciation method, don't automatically think accounting principle. Remember Becker's exception. Treat it as a change in estimate. Prospectively.
Okay. Next bucket. Accounting principles. This feels different already.
It is. An accounting principle means switching from one acceptable accounting method to another acceptable accounting method. Neither method is wrong. Management is simply adopting another acceptable approach.
Like switching inventory methods.
Exactly. Becker discusses situations such as changing inventory costing methods. Unlike estimates, this affects comparability across years. If this year's inventory uses one method and last year's financial statements use another, comparisons become misleading. That's why the normal rule changes.
Instead of moving forward, we look backward.
Correct. Retrospective application. Pretend the new principle had always been used. That's the basic mental model. Historical financial statements are restated. Beginning retained earnings is adjusted for the cumulative after-tax effect when required. Comparability is preserved.
Here's my analogy. Imagine a photo album. You decide every vacation picture should be organized chronologically instead of alphabetically. You don't start organizing only future vacations. You reorganize the entire album.
That's an excellent analogy. The only place it breaks down is remembering that accounting isn't changing history itself. It's changing how the history is reported so every period uses one consistent accounting method. Consistency is the goal.
Becker spends time explaining cumulative effect. Students hear that phrase and freeze.
The cumulative effect simply represents what retained earnings would have been at the beginning of the earliest presented year if the new accounting principle had always been used. It's essentially the catch-up adjustment needed before presenting comparative financial statements consistently.
Then Becker gives an important exception. Whenever Becker gives an exception, my ears perk up.
They should. Sometimes retrospective application is impracticable. If the cumulative adjustment cannot reasonably be determined, the change is applied prospectively. Becker specifically discusses the situation involving changing to U.S. GAAP LIFO from another inventory method. In that circumstance, you begin applying LIFO going forward rather than reconstructing years of unavailable information.
So, the exam isn't asking whether retrospective is the rule. It's asking whether this situation qualifies for the exception.
Exactly. Always know the general rule first. Then recognize the rare exception.
Now we move to reporting entities. This one always sounds more dramatic.
Because it usually is. A reporting entity change isn't about measurement. It's about who the company is reporting as. For example, financial statements might now include additional companies or present comparative information using a different reporting entity. Becker's rule is straightforward. Retrospective application. Restate prior comparative financial statements so they appear as though the new reporting entity always existed.
That actually feels logical. If I'm comparing this year and last year, both years should represent the same reporting entity. Otherwise, I'm comparing apples and oranges.
Exactly. Comparability drives the treatment again.
Now, let's get to errors. These feel emotionally different. Nobody wants to discover one.
Definitely. An error means something actually went wrong. Recognition, measurement, presentation, disclosure, applying GAAP incorrectly, or using a non-GAAP accounting method when GAAP should have been followed. Unlike estimates, errors aren't new information, they're incorrect information.
Here's another analogy. Estimate. You guessed someone's height from across the room. Later you measured it accurately. No mistake. Better information. Error. You accidentally read the tape measure upside down. That's simply wrong.
Perfect distinction. The accounting treatment follows naturally. Errors require correction because prior financial statements were incorrect. Becker refers to this as a prior period adjustment.
Which means we're fixing the past.
Exactly. Depending on which financial statements are being presented, comparative statements may be restated, or beginning retained earnings is adjusted net of tax. The key idea is restoring the financial statements to what they should have been originally.
Becker's comprehensive example combines several concepts: depreciation error, inventory method change, retained earnings. It's really testing whether you know which category each item belongs to.
That's exactly what makes it valuable. Notice the textbook isn't asking you to memorize dozens of journal entries. It's asking you to identify the nature of each change. Depreciation that was calculated incorrectly? That's an error. Inventory method voluntarily changed from LIFO to FIFO? That's a change in accounting principle. Different categories, different accounting.
I love that Becker separates comparative versus non-comparative presentations too, because students often overlook that.
Yes. If comparative financial statements are presented, prior periods are corrected. If earlier statements aren't presented, the correction generally flows through beginning retained earnings of the earliest period presented. Always pay attention to what financial statements are actually included in the question.
Let's build a rapid-fire decision game. I'm management. I learn my machine won't last as long as expected.
Estimate. Prospective.
I switch inventory methods.
Principal. Generally retrospective.
I discover last year's depreciation calculation was mathematically wrong.
Error. Correct prior periods.
I begin presenting consolidated statements including another company in comparative years.
Reporting entity. Retrospective.
I switch depreciation methods.
That's the famous exception. Treat it as a change in estimate. Prospective.
That last one still wants to trick me.
Which is why it's worth repeating. Depreciation method. Estimate. Prospective. Say it enough times that it becomes automatic.
Another thing I noticed. The words themselves give clues. Estimate sounds forward-looking. Error sounds backward-looking.
That's a great observation. The language often hints at the accounting. Forecasts affect the future. Mistakes require correction. Consistency requires retrospective application. Those ideas connect naturally.
Let's finish by putting the whole module into one mental picture. Imagine 4 doors. Every exam question walks through exactly one. Door 1 says estimate. Door 2 says principal. Door 3 says entity. Door 4 says error. Don't calculate anything until you've opened the correct door.
I love that. And here's what you'll find behind each door. Estimate. New information. Prospective. Principal. Different acceptable accounting method. Usually retrospective. Entity. Different reporting company. Retrospective. Error. Something was wrong. Correct prior periods with the appropriate retained earnings treatment when necessary.
Notice what we didn't do. We didn't memorize 20 isolated rules. We built a framework.
That's the goal. The Becker examples become much easier once you recognize which category you're reading about. Every question starts with classification. Everything else follows from that decision.
And if you remember only one sentence after this episode, make it this: before deciding how to account for the change, first decide what actually changed.
Exactly. That single question turns one of FAR's easiest to confuse topics into one of its most predictable.